Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into this recent downgrade by Moody's of U.S. government debt. At the end of the day, it wasn't a huge move from a credit perspective, but I want to get into it a little bit. In any event, just to go back to some bond concepts, there's this phrase that bond investors sometimes use, which is quote unquote money good. And that's the idea. That's a phrase used if people believe the bond issuer will honor its obligations, paying interest and ultimately repaying the principal at maturity. So that's one idea is the U.S. government debt money good? We probably think that it is at this point. Another concept is the idea of a risk-free rate. So for the longest time, in the way that the bond market prices almost, for example, T-bills are in the current moment are kind of viewed as the risk-free rate. You can get that return. And then whether it's maturity risk that you take or credit risk that you take, basically bonds priced with higher yields where there's a spread over the risk-free rate. And so, of course, to the degree that there's actually risk in treasuries, then it isn't quite risk-free. And it's almost like the math that backs the bond market starts to crack a little bit. So anyway, those are just a couple concepts that come to mind. Now, when it comes to this idea of the growing debt, growing interest costs, so higher rates, we've identified what we call and developed what we call a theme of financial instability in our geopolitical risk dashboard. And with that higher level of debt, higher level of rates, and therefore cost of debt, basically the potential for continued or even greater painful fiscal transition where things have to be sort of cleaned up after all that trouble. So anyway, Moody's downgraded U.S. government debt. So let's jump into some of those details. They brought it down to AA1, so the highest level of the AA category. And actually, they're the third rating agency to make that move. So actually, all the way back to 2011, Standard & Poor's downgraded the debt at that time, and they use a slightly different scale, but to what they call AA+. Fitch Ratings, which also uses a similar scale to S&P, brought their rating down in 2023, down to, again, AA+, basically the same category that lines up with that AA1 from Moody's. Now, of course, the prudent thing to do is to look and say, well, what does Moody's mean in this case by AA? And just to quote the way they describe it, it's, quote, judged to be of high quality and subject to very low credit risk, end quote. And actually the suffix one, just to get to that, is the higher end of that category. So, even though this is a move, right, a downgrade, it's down into a category and a subcategory with that number one that's still a very, very high quality. And so, in terms of whether or not the debt's at risk in the near term, is it quote unquote money good? This slight downgrade really isn't something to be overly concerned about. But I think for all three of the rating agencies to do that, it is yet another sort of shot across the bow, sort of a signal that the fiscal situation needs to be brought into focus. Now, a few numbers. So over the period 2020 to 2024, our deficit averaged $2.2 trillion a year, and our debt has grown to $36 trillion. Now, that means that the debt interest payments make up a big part of our discretionary budget. And that's against a backdrop where really the idea of either reducing spending or increasing taxes have been and seem to continue to be really unappealing from a political perspective. So Congress is, in a lot of ways, just not touching that. Now, there's a lot going on in terms of calculations for the expected deficit in 2025. I think there's a CBO estimate up towards 2 trillion, maybe it's 1.8, 1.9 trillion. And then I've seen other estimates that may be less than that, depending on how this reconciliation bill falls. But regardless, if we're in the trillions of dollars, round numbers, that's a lot, and that will increase our debt further. It sort of exacerbates the problem rather than improving it. Now, in the wake of this downgrade, we did see a modest jump in volatility. The popular measure for equity market volatility is the VIX index, and it jumped a little over 5% on this news. The MOVE index moving a little higher than that, and that's by the way, bond market and interest rate volatility up. That MOVE index up about a little over 7%. So modest moves towards more volatility. And then the other thing that's notable is that, if you think of what's called the term premium, the amount that investors want to get paid to hold a bond for a long period of time, basically for the 30-year Treasury, which is a longer dated Treasury issue, that yield has risen above 5%. And so this is a move that happened in the wake of this downgrade. And so again, think of it as on the margin, even though this is still a very high quality category, the market's reacting to the idea of, a slight weakening in the credit worthiness of the government, and rates have gone up a little bit, as has volatility. So when we look to the longer term, and we've been talking about this for a while, we're of the view that the government's going to need to get its act together when it comes to managing the budget, eliminating the deficit, and then managing our debt to sort of reduce it over time, especially as sort of a portion of our economy. And so the question remains, of course, what happens if we don't do that? Well, number one, of course, we know we risk losing our reserve currency status, the US dollar, and that sort of weakens our position. We know that investors could demand even higher yields to hold US debt. So they want to be paid a higher return to take on the quote unquote risk. And yet, a lot of this, and really the role of the U.S. and our government debt, for example, in the overarching capital markets and in the broader economy, brings into question if that, the reserve currency status and treasuries is sort of a risk-free type of investment. If that goes away, that basically shakes the foundations of some of our capital markets. And so we have to anticipate increased volatility, and certainly down the road, the risk of basically negative capital markets, bond and stock markets in the more severe scenario. Now, I always like to end this topic with a reiteration that we tend to be optimistic that the government will eventually focus on this issue, and leaders will step up and work on it. And we, as a resilient system and economy, will sort of work our way through it. But the action by Moody's, the downgrade to AA1, was another kind of wake-up call to politicians and voters that we need to focus on this going forward. Anyway, that's what I wanted to cover in this episode, kind of a somewhat negative topic, but remember, we remain optimistic. Thank you so much for listening to this episode, and we will catch you on the next one. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.